after we review the financial statements back in chapter 2, now in chapter 3 we're gonna look at the numbers or say the information from the financial statements and conduct ratio analysis. So ratio analysis is a tool to assess a company's performance and also financial health, and we are going to look at 5 big groups of ratios and try to also explain what is a so-called time series analysis, what is a so-called cross-sectional ratio analysis, and we will also apply DuPont analysis to look at a company's ROA and ROE. And of course, before that, we need to know what is ROA and ROE. So 5 groups of ratios: liquidity ratios, asset management ratios, debt management ratios, probability ratios, and market value ratios. We'll start one by one. Now before we start, let me just say the ratios listed in your textbook but not on this lecture slide will not be required for your exam. So I would say focus on the ratios that we discuss in this class on these lecture slides, and you don't have to worry too much about the ratios not covered in my lecture slides. So to study the ratios, we are using the information, the financial statements from chapter 2. So this is the balance sheet, and then we have the income statement. So we're gonna basically use the information in the balance sheet and income statement for our ratio analysis. First, we're going to study the liquidity ratios. So according to the name, liquidity ratios, of course, study a company's liquidity. So liquidity ratios measure a company's ability to meet its obligations, or say pay for its obligations as they come due. So the 3 most common liquidity ratios include current ratio, quick ratio, and cash ratio. If you look at the formula of these 3 ratios, you understand they actually share a same denominator, which is current liabilities. So again, this is consistent with the definition of liquidity ratios, which is about the concern of the company to pay off its current liabilities. Do we have enough cash? Can we make enough cash to pay for the current liabilities? So the current ratio is current asset over current liabilities, or say we're comparing how much we have as current assets with current liabilities to see if we are covered. Now, among all the current assets, some actually are not very liquidable. For example, inventory. So if we really want to look at the highly liquidable current assets, we want to exclude inventory from all our current assets. So actually, in quick ratio, we look at, for example, cash and account receivables, and we look at how cash and account receivables together compare to current liability and see if we are covered. Now, cash ratio is the most strict ratio among the 3. So cash ratio only look at cash itself and see, do we have enough cash right now to cover the current liabilities. The calculation of these ratios are actually really straightforward. For example, if you want to calculate the current ratio of this company for this year, current asset divided by current liability, current asset you should be able to find it from the balance sheet, and current liability, of course, you can also find it from the company's balance sheet. So you do the calculation, you realize it's 1.71 times. Comparing to the industry average, this company's current ratio is actually a little bit higher. Now, quick ratio, you exclude inventory from all current assets, and both these numbers can be found from the company's balance sheet and divided by current liability. So quick ratio is about 0.78 times, a little bit higher than the industry average. Cash ratio, cash balance amount, you can find it from the balance sheet. Okay, so if you need more explanation about how to get these readouts, click here to go to the textbook website, and you can see a video that explains how to get these readouts. I will also have the link to this video under the web links in D2L. So if we look at these readouts, you may think, okay, 1.71, so what? By looking at these numbers, we can say that the company has higher liquidity, or say more liquidity than the industry average. Usually we say the more liquid asset a company holds, the higher liquidity ratio it has, then the more likely the company can pay its bills, or say pay off its current liabilities. So that means it has less liquidity risk. So liquidity risk simply is the risk of you not having enough liquidity and therefore cannot pay your bills. However, liquid assets such as cash do not really generate much profit or return for the company. So if you have too much liquid assets, or say if your liquidity ratio is too high, that means your return may be affected, or say you are not using enough of your resource to generate profit or return for the company. You're just having too much liquidable assets. So managers need to consider the trade-off between lower liquidity risk versus the disadvantage of reduced profit. So if your liquidity ratio is high, it's good that you have lower liquidity risk, but then you may have the disadvantage of reduced profit since you have too much cash and you're not investing enough into the assets that can generate profit or returns for you. So this is the trade-off that we need to be aware of. Next group of ratios, we are talking about asset management ratios. So according to the name, we understand these are the ratios that study how efficiently a company manages or uses its assets. Speaking of the assets, we're talking about different kind of assets. So we're talking about, for example, inventory, accounts receivables, and so we have ratios for each type of the assets. If we look at inventory, we have inventory management ratios. So the first one we look at is the inventory turnover ratio, measures the dollars of sales produced per dollar of inventory. So you can think of this as how many times your inventory turnover in a year to make your products, or say to be turned over to account for the cost of goods sold. If you remember from your accounting classes, the value of your inventory will be counted into the cost of goods sold. So if your cost of goods sold is several times of your inventory balance, we can think of it as the times that the inventory has turned over within a year. So the higher this number is, that means you turn over your inventory faster within a year in your company. Another ratio which is actually pretty related to the inventory turnover is called the days sales in inventory. So basically this ratio means how many days on average would you turn over your inventory, or say how many days on average that you are holding your inventory. So if you multiply these two ratios together, you actually will end up with one fixed number, which is 365, or say that's the number of days in a year. So for inventory management ratios, a company wants to turn inventory over as quickly as possible, so you want to achieve a high inventory turnover ratio. Generally, a high inventory turnover ratio or a low day sales in inventory ratio indicate good management, or say you are using your inventory pretty efficiently. However, if inventory balance is too low, then the company may risk losing sales or running out of raw materials. And so there is actually also a trade-off between sufficient level of inventory versus the cost of holding too much. And companies with good supply chain relations can maintain lower inventory levels. So if you have a good relationship with your suppliers, whenever your inventory level is low, or as it gets a little bit too low, you can actually get the supply pretty fast. And if that's the case, it's actually okay, or it's okay for you to maintain a lower inventory level. But if you do not have a good supply chain relations, then you may actually want to keep a higher inventory level, just in case that you may run out of your inventory or raw materials later. So if that's the case, you may actually have a low inventory turnover ratio because you have to keep a high inventory balance level. Second kind of asset we want to look at is accounts receivable. So accounts receivable management is about how fast can you recover or say collect your account receivable. So the first one we look at is called the average collection period, and it is calculated as your account receivable balance from your balance sheet multiplied by 365 divided by the so-called credit sales. You understand that you have account receivable because you sell some of your products or provide some of your service on credit. So when that happens, your customers do not pay you cash immediately. When you sign the contract, the transaction occurs, but you don't have the cash. You don't receive the cash immediately. What you will have is account receivable. Now, how long would you take to collect money from those account receivables? That's what the average collection period ratio tries to measure. So, of course, if this number equals to, for example, 60, that means you take on average about 2 months to collect your account receivables. If the number is about 10, that means on average it only takes you about 10 days for you to get cash out of all those credit sales. Many times we would not have information about a company's credit sales because companies are not required to report the credit sales on their financial statements. So if that's the case, we can just use total sales or say total revenues instead of credit sales in this formula to calculate the average collection period. Now, the next ratio regarding to account receivable management is called account receivable turnover. So this ratio is also very related to the average collection period. So if you think about it, if you take about 60 days on average to collect your account receivable, then that means on average you will turn over your account receivable about 6 times in a year. So account receivable turnover roughly measures on average how many times would your account receivable be held within a year, or say it will be turned over within a year. So it is calculated as a credit sales divided by the balance of accounts receivable. Notice that credit sales sometimes again may not be available for you, so you may want to use the total sales or total revenues instead. And this number, the total sales or revenue will be obtained from income statement, while the accounts receivable will be obtained from balance sheet. Companies want to produce a high level of sales per dollar of accounts receivable, and so you want to turn over your account receivable into cash as quickly as possible. You want cash, so you don't want your accounts receivable to sit there for too long. A high account receivable turnover ratio and a low average collection period are indicators of good receivable management. So the faster you can get your cash back, the better. However, if these numbers are too good, that may indicate that the credit terms are too strict. And if your credit terms are too strict, your customers may not like it, and that means that your company may be losing sales because of the very tight credit policy. So again, managers need to consider the trade-off. Do you want to collect your cash as fast as possible, or sometimes do you also want to maintain a good relationship between you and your customers? And if that's the case, maybe you do not want to have a very tight credit policy for your customers. Since we talk about account receivable, which is the money you're going to collect from your customers, we can also look at account payable, which is the money you are going to pay to your suppliers. So we also have the account payable management ratio, which measures the number of which measures how efficiently you are managing your account payable. So the first ratio is an average payment period, and that measures the number of days that the company holds account payable before it has to extend the cash to pay to the suppliers for the raw materials you buy from your suppliers. So if you look at this formula, it is actually very similar to the formula of average collection period. Remember, average collection period is simply account receivable balance multiplied by 365 and then divided by credit sales. Account payable, for the account payable, the average payment period is account payable balance multiplied by 365 and then divided by the cost of goods sold. And so for example, if APP equals to 60, that means on average it takes you about 60 days for you to pay your suppliers. And if we also look at a so-called turnover ratio for the account payable, it would be cost of goods sold divided by the balance of account payable. Again, these two ratios, if you multiply the average payment period with account payable turnover, the result should also be 365. Sometimes we use sales instead of cost of goods sold in these two formulas. So in your exam, if I want you to calculate the average payment period, I will let you know, I will give you instruction about whether you should use sales or cost of goods sold. Either way, in practice, either way is fine, but in the exam, I will specify whether you should use sales or cost of goods sold. Speaking of the meaning of the account payable ratios, we want to say that firms want to pay for purchases as slowly as possible. This is different from account payable. You want to get money back from your customers as fast as possible, but when it comes to you paying, you want to pay as slowly, as late as possible. So account payable represent a form of financing from suppliers, and the longer they can wait, the longer you make them wait, the better actually it is for you. So the more the account payable you have, the less the company will need other costly sources of financing, such as no payable or long-term debt. So the longer you let your suppliers wait, the lower need of cash you need to come up now. So that means you don't have to worry too much about getting the cash now, and that lower your need of getting other sources of financing, such as note payable. So you don't have to borrow from your bank so that you get the cash to pay your suppliers if your suppliers actually can wait longer. So we say a high APP and a low account payable turnover ratio usually is a good sign, a sign of good management. But think about it. If you keep your suppliers waiting for too long, if those ratios are too good, that may indicate that your company is abusing your credit terms from your suppliers, and that may jeopardize the relationship with your suppliers. So again, that's a trade-off that you need to be careful about.